Hi everyone! Welcome back to Money is Money. Today, we're going to talk about how to invest in the stock market. Investing in the stock market can seem daunting, but it's a powerful way to build wealth over time. Whether you're a beginner just getting started or looking to refine your investment strategy, understanding the basics is crucial for making informed decisions. We'll cover the fundamentals, from what stocks are to different investment strategies you can use. Knowing how the stock market works will give you the confidence to invest wisely and build a solid financial future. First, we'll start by understanding the basics of the stock market. Then, we'll move on to setting your investment goals and exploring various strategies. Finally, we'll discuss how to choose the right brokerage account and the importance of staying informed. So, if you're ready to learn how to make your money work for you, grab a notebook, sit back, and let's dive into the world of stock market investing. If you find this video helpful, don't forget to like, subscribe, and hit the notification bell for more financial tips. Let's get started. First, it's important to understand the basics of the stock market. Stocks represent shares of ownership in a company. When you buy a stock, you become a part owner of that company. When you own a share, you have a claim on part of the company's assets and earnings. The value of these shares can go up or down based on the company's performance and market conditions. Key terms to know include dividends, which are payments made to shareholders from a company's profits. Not all companies pay dividends, but for those that do, it's a way to earn income on your investments. Another important concept is market capitalization, or market cap. This is the total market value of a company's outstanding shares. It's calculated by multiplying the share price by the total number of shares. Market cap helps you understand the size of a company and compare it to others. Companies are often categorized by their market cap: large cap, mid cap, and small cap. Large cap companies tend to be more stable, while small cap companies might offer more growth potential but come with higher risk. Understanding these basic terms and concepts is the first step in becoming a savvy investor. With this foundation, you'll be better prepared to make informed decisions about your investments. Before you start investing, it's crucial to determine your investment goals. Are you saving for retirement, a down payment on a house, or your child's education? Your goals will help shape your investment strategy and determine your time horizon and risk tolerance. For example, if you're saving for a short-term goal like a down payment on a house within the next few years, you might choose more conservative investments to protect your capital. Conversely, if you're investing for long-term goals like retirement, you might be willing to take on more risk for the potential of higher returns. Understanding your risk tolerance is key. This is your ability and willingness to lose some or all of your original investment in exchange for greater potential returns. Investors generally fall into one of three categories: conservative, moderate, or aggressive. Conservative investors prioritize capital preservation and may focus on bonds and other low-risk investments. Moderate investors balance risk and reward, often with a mix of stocks and bonds. Aggressive investors seek high returns and are willing to accept significant volatility, often investing heavily in stocks. By clearly defining your investment goals and understanding your risk tolerance, you can create an investment plan that aligns with your financial objectives and personal comfort level. This foundation is essential for successful investing. There are various investment strategies to consider when diving into the stock market, each with its own potential benefits and risks. First, we have growth investing. This strategy focuses on investing in companies that are expected to grow at an above-average rate compared to other companies. Growth stocks typically reinvest their earnings to expand, rather than paying out dividends. These companies are often in the tech sector or other innovative industries. The potential for high returns is significant, but so is the risk. Next is value investing. This strategy involves buying stocks that appear to be undervalued by the market. Value investors look for companies that are trading for less than their intrinsic worth, often identified by strong fundamentals but temporarily unpopular with investors. The goal is to buy low and sell high as the market corrects itself. This strategy can offer substantial returns, though it may require patience. Another popular strategy is dividend investing. This approach focuses on companies that pay regular dividends to their shareholders. Dividends provide a steady income stream, which can be particularly attractive to investors seeking stability and passive income. High dividend stocks are often found in mature industries such as utilities, telecommunications, and consumer staples. Understanding these different strategies can help you make more informed investment decisions. You might choose to focus on one strategy or diversify across multiple approaches to balance risk and reward. Remember to research each strategy thoroughly and consider how they align with your investment goals and risk tolerance. By learning about and considering these various investment strategies, you can better position yourself to achieve your financial objectives. Whether you're aiming for growth, value, or consistent dividends, there's a strategy that can help you navigate the stock market successfully. To start investing in the stock market, you'll need to open a brokerage account. There are many online platforms available, each offering different features and benefits. Some of the most popular options include Fidelity, Charles Schwab, and Robinhood. When choosing a brokerage account, it's important to compare fees, account minimums, and the tools and resources each platform provides. Fees can vary significantly between brokers, and they can eat into your investment returns. Look for accounts with low or no trading fees, and be aware of any hidden costs. Next, consider the account minimums. Some brokers require a minimum deposit to open an account, while others have no minimums at all. Make sure you choose a platform that aligns with your initial investment amount. Additionally, the tools and resources offered by the brokerage can be invaluable, especially if you're new to investing. Look for platforms that provide educational materials, research tools, and user-friendly interfaces. Some brokers offer advanced trading platforms with detailed charts and analysis tools, while others focus on simplicity and ease of use. Taking the time to compare different brokerage accounts will help you find the one that best fits your needs and investment style. Once you've chosen a brokerage, you'll be ready to start buying and selling stocks. Be sure to read reviews and maybe even test out a few platforms to see which one feels right for you. By selecting the right brokerage account, you set a solid foundation for your investment journey. With the right tools and resources at your disposal, you'll be better equipped to navigate the stock market and work towards your financial goals. When you're ready to start investing, it's wise to start small and diversify your portfolio. Diversification means spreading your investments across different sectors and asset classes to reduce risk. By diversifying, you're not putting all your eggs in one basket, which can help protect your portfolio from market volatility. Consider starting with index funds or ETFs, exchange-traded funds. These funds are designed to track the performance of a specific index, like the S&P 500, and they provide broad market exposure. Investing in index funds or ETFs can be less risky than picking individual stocks because you're investing in a wide range of companies at once. Starting small allows you to learn and gain experience without risking too much capital. As you become more comfortable and knowledgeable, you can gradually increase your investments. Remember, investing is a long-term game, and it's important to be patient and avoid making impulsive decisions based on short-term market movements. Balancing your investments between different asset classes can also help manage risk. For example, you might allocate a portion of your portfolio to stocks for growth potential, bonds for stability, and real estate for additional diversification. This approach helps smooth out the ups and downs of the market and can lead to more consistent returns over time. By starting small and diversifying your investments, you'll build a strong foundation for your portfolio. This strategy helps mitigate risk and increases the likelihood of achieving your long-term financial goals. Stay informed, keep learning, and remember that diversification is key to successful investing. Investing in the stock market requires staying informed about market trends and company news. Regularly review your portfolio and make adjustments as needed. Keeping up with financial news can help you understand broader market movements and how they might affect your investments. It's important to remember that investing is a long-term game. The stock market can be volatile in the short term, but historically, it has shown growth over the long term. Don't let short-term market fluctuations deter you from your long-term goals. Patience is key. Being patient means giving your investments time to grow and compound. It's normal for the market to have ups and downs, but if you stay invested and avoid making impulsive decisions, you'll be more likely to achieve your financial goals. Regularly review your portfolio to ensure it aligns with your investment goals and risk tolerance. Rebalancing your portfolio, which involves adjusting the proportions of different assets, can help you stay on track. This might mean selling some assets that have performed well and buying others that haven't, to maintain your desired level of diversification. Staying informed and being patient are crucial components of a successful investment strategy. By doing so, you'll be better equipped to make informed decisions and stay focused on your long-term objectives. Remember, investing is a journey, not a sprint, and with time and patience, you can achieve your financial goals. By staying informed and exercising patience, you'll navigate the stock market with greater confidence and poise. Stay committed to your investment plan, continue learning, and keep your long-term goals in sight. These habits will set you up for success in the world of investing. Investing in the stock market can be a powerful way to build wealth over time. By understanding the basics, setting clear goals, choosing the right strategy, and staying informed, you can make smart investment decisions. Start by learning the fundamentals of the stock market, determining your investment goals, and exploring different investment strategies. Choose the right brokerage account, start small, diversify your investments, and always stay informed. Remember, patience is key in the world of investing. By following these steps, you'll be well on your way to making informed and confident investment decisions. Don't wait. The sooner you start investing, the more time your money has to grow and work for you. Start investing today and take control of your financial future. If you found this video helpful, please like, subscribe, and hit the notification bell for more financial tips. Thanks for watching, and happy investing!